New Delhi is facing a rather difficult question. Should it keep buying Russian oil? Last year, the answer was easy. Oil had reached almost $120 per barrel and Russia was giving us discounts. How much? Up to $30 per barrel. So buying from Russia was a no-brainer. But that's not the case anymore. And there are two reasons for that. One, the discounts are evaporating. From $30, it's now reached $4. Though when you buy millions of barrels, that's still a lot of money. And secondly, the threat of Western sanctions. You see, the G7 has imposed a cap on Russian oil, $60 per barrel. If you pay 60 or less, you're fine. You're safe from Western sanctions. But if you pay more than $60 per barrel, you're in trouble. The idea of this cap is to limit Russia's oil revenues. Until now, this was not really a problem. Russian oil was priced below the G7 cap. But on Wednesday, that changed. Russia's Ural grade oil crossed $60 per barrel, meaning it's over the price cap. So what can India do? Well, politically, there is not much to fear. Western nations have largely accepted India's position on Russia. But financially, it's a tough call. If you buy Russian oil above $60 a barrel, you lose access to a lot of things, like Western insurance services or Western shipping services. Now, these are big parts of the oil trading industry. We are talking about multi-million-dollar cargoes. They travel hundreds of kilometers through the open seas. It's a risky voyage. What if a ship meets an accident, or maybe there could be a theft or an explosion? In such cases, all parties would lose millions of dollars. So what do? They take out marine insurances. They will ensure that their losses are covered, a bit like your car insurance, just multiplied by thousands. And that's where the G7 holds an edge. Their companies, G7 companies, control around 90% of the maritime insurance market. 90%, 90. If you buy at $60, you get their services. And if you don't, then you have to opt for shady networks, the ones used by sanctioned countries like Iran or Venezuela. Needless to say, that's not ideal. So what can India do? There is a strategy that Russia is already using. First, they bill the oil at less than $60, so no sanctions. Then they bill separately for shipping services, not Western ones, but their own Russian fleets. And they can charge anywhere between $11 and $19 per barrel. It's pretty high though, almost double the normal shipping rate. If you want Russian discounts, this is your only option. And a lot of trade is already happening like this, through shady Russian tankers. The question is, should India keep doing it? The risks are higher, the discounts are falling, and the dependence is alarming. You see, before the war in Ukraine, Russia made up just 2% of India's oil imports. Now it is more than 45%. That sort of dependence is fine if you get excellent deals. But at $4 discounts, is it really worth it? Indian officials and refiners are struggling with this question. Their options are limited. You can't pay in dollars because of sanctions. You can't pay in rupees either because Russia already has $2 billion worth of Indian currency and they have nothing to buy with it. You also can't pay in the Chinese yuan. India's state-owned companies have been asked not to do so by the government. The private ones are not too keen either. Why? Because the Chinese currency is not fully convertible. There are a couple of deals happening, but it's not a feasible solution. So New Delhi needs to ask itself two questions. One, is this current system of payments adequate? The answer is no. Shady tankers and invoices are not a long-term solution, especially when it makes up 45% of your oil imports. So India needs a stable payment system. If not the rupee ruble rather, then something else. And question number two is this. Is it time to look beyond Russian oil? And this is not about ethics or politics. They don't matter for ordinary people who are at the petrol pump. It's about strategy and finance. Should half of your oil imports be at the mercy of shaky payments and shipping? If the money is good, then fine. If not, India needs to look for backups, which is why the Russian discounts are so crucial. Many experts say India should ask for better deals, and why not? European demand for Russian oil is nil. Chinese demand has peaked. So India is clearly their biggest market. Take a look at this data from June. It shows the export of Russian Ural grade oil. Turkey bought 780,000 tons. China bought 1 million tons. Now look at how much India bought. 5 million tons. That sort of market power should come with certain benefits. So why hasn't it? Reports say because of bad bargaining. The state-owned companies make up 60% of India's imports. If they negotiate together, they can get better deals. Unfortunately, that is not happening. Only Indian Oil has struck a fixed volume deal. The rest are buying on tender basis. So the bottom line is this: if India is keen on buying from Russia, we need better systems in place, easier payments, safer shipments and better discounts.